Good afternoon, everyone. Welcome to our office today for our second federal budget event for 2022, our federal budget 2022 sundowner. So the sun, for people who don't know where we are on the compass, the sun will be going down somewhere in that direction there. Probably hasn't come up today, but welcome to our sundowner event. I'm Stuart Dell, partner at Pitcher Partners in our tax advisory practice here in Melbourne. Before we begin, I'd like to acknowledge the traditional owners of this land. Our event today is being held on the lands of the Kulin Nation, and I wish to acknowledge them as the traditional custodians and pay respect to the past, present and emerging generations of the Kulin people. We're delighted to host you here today to analyse the new government's first foray into its approach to economic management and what it means for you, our clients, comprising some of the most successful businesses and business people. As is now often the case, since 2020, we're running a hybrid event live streaming here as well today, as well as hosting a number of you here in person. For regular attendees, the timing of our event is a bit different this year, part of our effort to bring you the budget analysis quicker than ever, and a great opportunity to catch up without having to worry about having that little bit of annoying spinach in your teeth over breakfast. For those in the room, we really hope you're able to stick around after today's presentations to meet some new people, catch up with old friends, or ask some additional questions of our speakers. And there'll be some drinks and nibbles here. So why are we all here this afternoon? Well, we make it our business to know and support the issues and challenges of your businesses. Pitcher Partners' recent Business Radar report showed us that Australia's entrepreneurs in the middle market remain resilient and optimistic, but are facing challenging times due to rising interest rates, rising inflation, and a challenging labour market. Our Business Radar report provides qualitative and quantitative data from a broad-based survey of our clients, along with analysis and actionable insights from business and financial experts at Pitcher Partners. You can read more in the full report by scanning some of the leaflets that are around here today and on the QR codes. And otherwise, if you're watching live stream, you'll see it there looking prominent on our fantastic website. And in today's analysis of the budget, our speakers will help you understand the key changes that may impact your business and help you adapt to those current challenges. It's clear that the objective of this government's first budget has really been to set the scene, managing the electorate's expectations for some tougher days ahead, whilst trying to make good on some of the headline election commitments to address housing affordability and some productivity initiatives through cheaper childcare and expansions to the paid parental leave scheme. Energy costs, that was one of the election promises, not so much. And certainly with the cost of housing and cost of living, the focus seems to be on supply side initiatives rather than things like direct cost of living handouts and the fuel excise cut, which we had in the last budget back in March. The star of the night last night in terms of expenditure items in the budget was arguably interest on government debt, nudging $1 trillion of debt and interest cost to service that debt that's going to climb up to around $70 billion per annum. It's the fastest growing expenditure item in the budget. From a business and tax perspective, not too much on the positive front last night, I'm afraid. A relatively cautious productivity agenda, largely reshuffling existing program funding commitments of the previous government, along with some increased ATO activity, focusing some tax measures on a soft target, multinationals, with some measures that don't just impact the mega multinationals that you might think so at a headline level, but potentially impact other businesses that may have a global footprint. On the bright side, there are a number of tax incentives that have got some time to burn before they end in 30 June 2023, and I'm sure our speakers will tell us more and remind us what some of those measures are. So for a more in-depth analysis of the announcements and their impact, it's time to hear from the experts we have joining us today. Three great speakers, each talking about the federal budget through the lens of economic, tax and business, followed by some Q&A to answer your questions. First up, Sally Auld will share her take on the budget and what it means for our nation's economy. Sally's the Chief Investment Officer at JB Were. She joined JB Were in September 2020 from JP Morgan, where she was Managing Director, Chief Economist and Head of Economic and Market Research for Australia and New Zealand. She's also worked in economics and market research at both ANZ and Credit Suisse. Sally's based in Sydney, so we're really lucky to have Sally join us in Melbourne today. I said that maybe she brought some Sydney weather, sort of muggy and a bit cloudy today, but I'm told by some of the Sydney-siders, including Sally, that it's beautiful 28 degrees and sunny today. Anyway, you'll see that Sally's a sensational speaker on economics with some great insights, so really looking forward to hearing her thoughts. Following Sally, we're going to hear from our own Brian Farrelly. A partner of our firm in Melbourne, Brian specialises in tax advisory with expertise in income tax for corporates, trusts and large family groups. He provides services to a broad range of clients from startups to multinationals. There are a number of relevant tax measures in the budget, perhaps not that obvious. Brian will show us where they are. There always is. A Kiwi national, Brian's still also grinning from the New Zealand defeat of Australia at the T20 tournament a few days ago. But don't worry, Brian, the Aussies are back. We won again last night, I believe. Speaking of cricket, can you believe that there were 90,000 people at the MCG on Sunday for India versus Pakistan in the T20? And I hear this next man's trying to get a test match organised to have 5 days. Imagine that, 5 days of a crowd of 90,000. Australia's not even on the field. Following Brian, we're going to hear from Paul Guerra, Chief Executive at the Victorian Chamber of Commerce and Industry, Victoria's leading business advocacy organisation. Paul's an internationally experienced leader who's held CEO, Managing Director and Chairman roles across Asia Pacific, spanning several key industries. With the Victorian election just around the corner and the federal government committing vastly more to Victoria than any other state in last night's budget, I expect Paul's going to have plenty to say and some great insights about the current and future state of the state of Victoria and the businesses that operate in it. As I said, we're also going to have some time for Q&A at the end, so please do submit a question to our speakers. Use the details on the screens that you'll see on various slides that will come through, including the one that's there before you at the moment. Go on to the Slido website, slido.com, and use that code that's pictured there, hashtag PPFB22 to submit your questions. Whether you're joining us in person or through the live stream, please submit all your questions through Slido. Now, it's my great pleasure to introduce our first speaker for today's event, Sally Auld. We're really fortunate, as I said, to have you join us here today, Sally, and share with us what you see as some of the bigger impacts in the federal budget.
Thank you, Stuart, for that very kind introduction, and good afternoon, everyone. Okay, so I've called this budget 22-23 Mark II because, as Stuart said, this is the second time that we've had a budget. We've actually had 4 in the space of 2 years, which sort of feels like overkill, but I guess that's an indication of the times that we're in. And I guess there were, really 3 themes that I thought were relevant for assessing the merits of this budget. And they were really the sort of interplay between fiscal and monetary policy, what the budget has done to try and set us up for longer term fiscal sustainability, and then also a sense of, I guess, really, as Stuart alluded to, what we're seeing in terms of structural reform efforts to lift the standard of living in Australia and also the productive capacity in the economy. So that were the 3 sort of, I guess, benchmarks that I thought we should assess the budget by. And I think the budget probably passes muster on all 3, some more than others. But I guess the first sort of story really on the budget is shown by these 2 slides here, or 2 charts here. And the one on the left is basically just what's happened this budget versus what happened at what we call PEFO. And so you might be going, what the hell is PEFO? PEFO stands for Pre-Election Economic and Fiscal Outlook. So basically we have a rule that every time an election is called, the Treasury needs to produce a document that states or sets out where the fiscal finances sit at that point in time and what the economic outlook is. And so that's the sort of benchmark for either side of politics to consider their policy options. So we had the budget in March, and then we had PFO in April, and now we have the new budget in October. And so the relevant benchmark is not what happened in March, but it's what the numbers said in April. And so when we think about what those forecasts were for the budget over the next few years back in April, that's the dark blue columns on that chart. So you can see pretty meaningful deficit for the current fiscal year, close to $80 billion. And the light blue bars are basically what the new forecasts were last night. And so when you look at that chart, you say, well, aside from the current fiscal year, not much changed in the out years, right? A little bit higher, a little bit lower. But there was a remarkable improvement in the budget balance for the current fiscal year, almost a little bit over $40 billion. And so what's driven that? Effectively, it's just the consequence of two things: having very elevated commodity prices. And so one thing about the Australian budget is that it's actually very sensitive to the ups and downs in commodity prices. And they give you some examples of that sensitivity in the budget papers. But because commodity prices are inherently volatile, the way the Treasury deal with them from a forecasting perspective is to say, look, we just basically assume in every budget that prices revert to long run averages pretty quickly. And so the sort of numbers that they put in for our major commodity exports like iron ore and coal are often sort of around the $55 a tonne mark for iron ore and maybe a little bit higher for coal. And in large part due to what happened earlier this year when Russia invaded Ukraine, commodity prices were very elevated for most of 2022, and that's resulted in far greater tax revenues from the mining sector than the government had forecast. So you get a huge windfall gain from higher commodity prices. But the other thing that's driven the improvement in the deficit has basically been the fact that the economy has been very strong for pretty much all of this year. The unemployment rate has fallen to a multi-decade low. And so what that means for the government finances is that they're getting more income tax revenue as more people are employed. As wages growth is lifting, that's helping to lift income tax revenue. And of course, on the other side of the budget, they're having to pay out fewer unemployment benefits. So those two things alone basically account for $40 billion difference between April and October, which is pretty remarkable. The bad news on the sort of longer term fiscal story is the chart you see on the right there. And so the dark blue bars are sort of history, what's happened, and the light blue bars are the government's or Treasury's long run forecasts for Australia's budget for the next decade. And so you see pretty much deficits as far as the eye can see. And what that chart tells you is that we are running a structural deficit in Australia. So effectively, the economic assumptions that underpin those light blue lines are that the economy just operates at its trend level. So it's not too strong, it's not too weak. And that chart basically tells you that even if everything's just sort of running at trend, growth is about 2.5%, inflation's at about 2.5%, our budget is such that it will permanently be in deficit before we even make any sort of decision around what we want to do. And actually, one thing the government or the Treasury did do in last night's budget is they actually downgraded the long run productivity assumption for Australia. So they cut that from 1.4 down to 1.2. And that might not sound like a lot in terms of a change, but it actually has quite a significant influence on the deficit numbers in the year ahead. So this is the sort of conversation starter, I guess, that the Treasurer wants to have, which is that we've got a budget that is in permanent deficit. So we're spending too much, we're not raising enough, and hence we need to start making some sort of tough decisions. So good short-term story, not so great for the longer term. When we think about that first criteria we talked about, the stance of fiscal policy, you might sort of think that it's just common sense that monetary policy and fiscal policy would be working together towards the same outcome. But in fact, when you look back over the last decade, what you'll find is that there are more times when fiscal and monetary policy were working at cross purposes than times where they were working together. And so if you recall pre-pandemic, the RBA was going through a process of accepting that it had to continue to lower the cash rate. And there were many occasions where the RBA governor stood up and said, we have to be honest about what's going on in the economy. Monetary policy can't solve all the problems. We can't do it ourselves, and perhaps there's a role for others to get involved. And what he really meant was, we're trying to do our bit to bring the unemployment rate down, get a little bit more inflation, but the government is working at cross purposes with us and obsessing over running a budget balance or a small surplus. And so fiscal policy is contractionary, monetary policy is trying to be expansionary, and then on net, we're not getting the outcomes we want. The pandemic changed all of that. And I guess the way policymakers are thinking now is that there's now an accepted wisdom that there is a bigger role for fiscal policy to play. And it makes sense that both those arms of economic policy try and work together. So one of the important objectives of last night's budget was that it didn't do anything to exacerbate the set of circumstances that the RBA is facing into, which, let's face it, are a pretty nasty set of circumstances. Inflation, we got the latest read on that today. 11.30, is now running above 7% on the headline measures, above 6% on the core measures. Those numbers were worse than expected. And so probably means the RBA is going to have to go further in terms of the rate hikes it delivers over the next 6 months. So it's trying to cool the economy, take some heat out of the economy, bring aggregate demand and aggregate supply into balance in order to try and bring that inflation trajectory down. So it was super important that fiscal policy and last night's budget didn't exacerbate that set of circumstances. And so the chart on the left there are lots of different ways you can look at this problem, but the chart on the left is one way of assessing, is fiscal policy contractionary or is it expansionary? And if it's above 0 on that chart, basically it's contractionary. If it's below, it's expansionary. And so what you see from that chart, and these are numbers from the IMF, is that we're running modestly contractionary fiscal policy. So that, together with the fact that there weren't huge amounts of handouts last night, and very sort of measured medium-term cost of living relief all around, bringing down, say, medicine prices, childcare subsidies. These are all things that won't put money into people's pockets straight away. So the government gets a tick for that. And then the chart on the right basically just sort of shows you this idea that they are trying on one level to make some progress on putting the budget onto a better footing. And so what this chart shows here is growth in what's called real payments. So what we mean by that is payments adjusted for the rate of inflation, and taken averages, over certain periods. And what you can see is on the government's forecasts, growth in real payments is actually going to be much lower than it has been for most of the last decade. And so the government is showing this chart and saying, look, on our forecast, we think we're actually going to be spending on average, or growing spending on average at lower rates than previous governments. So a tick there. The only thing I would say about that chart is if we go into recession in 2023, that chart will be wrong. So the government will be, by definition, spending a lot more than it actually thinks. So it's a nice chart, but it's very, I think, specific to the RBA engineering a soft landing, which they have said is a narrow path. Just in terms of markets, broadly, there just wasn't much of a story for us. I don't think it was pretty neutral for equity markets. And I guess, we've all become acutely aware of the link between bad fiscal policy and financial markets, given everything that's played out in the UK over the last couple of weeks. So, when you looked at what government bond futures did at 7:30 last night when the budget came down and what the Aussie dollar did, they were largely unchanged, right? So no reaction from financial markets at all with last night's budget. One thing I do think is a little bit interesting just in terms of the equity market is that chart there on the left. And so what we find is that nominal GDP growth, so that's basically how much we produce and at what price, basically correlates really nicely with earnings growth or estimates of 1 year ahead earnings growth. And that makes sense, right? I mean, the speed rate at which the economy grows effectively anchors the rate at which companies in aggregate can grow their earnings. And if you have a look at the forecast that analysts have put in for earnings growth, and you have a look at the forecast that the government's put in for nominal GDP, what you see is that they broadly sort of line up over the next year. But then if we go a year further out, what you find is that the earnings estimates are a little bit more optimistic relative to where the government sees the economy tracking. So maybe that sort of suggests that, there's still a little bit more scope for equity analysts to get out their red pen and mark down what their what their earnings forecasts are. And that would be why one reason as a house that we still remain a little bit cautious on the path for equity markets over the next couple of quarters. And just in terms of the forecast, so, obviously Treasury puts out a set of forecasts. And so what you can see there on that table is just a number of sort of key indicators. So economic growth, inflation, the unemployment rate and wages. And the numbers in parentheses are what was in PFO. So what they thought the forecasts were back in April. And basically the story there is growth is going to be much weaker in the year ahead than we thought was the case back in April. And that's largely a consequence of two things: a much weaker outlook for the global economy. So recession in Europe and the UK, likely recession in the US, and China growing well below its sort of trend rate of growth. And so growth in this sort of fiscal year is a bit above 3. So that's still above trend growth for the domestic economy. But in the following fiscal year, growth downshifts to about 1.5%. And most of that slowdown is, when you look at the government's forecasts and what underpins that slowing in growth, it's all to do with household consumption. And we shouldn't be too surprised by this, because we know three things are happening. Rates are going up, so mortgage payments are rising, and that will crimp disposable income. And the government's forecast in this table, you can see that real wages growth is going to continue to be negative for all of this financial year, and only just slightly positive next financial year. And then, of course, we have the forecast that the government gave us last night around where it thinks energy prices are going to be tracking this year and next. So up 20% this year, up 30% the year after. So no surprises that it's household consumption that takes the real hit in that environment, and that's what's driving the big slowdown in growth. You can also see the inflation numbers have been lifted quite significantly as well. So if you actually look at where the government thinks inflation will land by the end of this year, it's pretty similar to the RBA, just shy of 8%. And the story really is that inflation stays higher for longer in their forecasts. And you can see, it's only really by sort of 2024 into 2025, so 2 years away from now, that inflation is expected to get back to levels that is consistent with the RBA's target. So what that tells you is that, the RBA still has a fair amount of work to do in order to be sure that inflation is consistent with its long run target. And then wages is the other interesting one. So, a lift in wages, many of you, I'm sure, run your own businesses, and you will probably be on the front line of this story. But we've sort of got this interesting situation in Australia where the RBA is saying, look, we think we're a little bit different here. Headline inflation in Australia is not as bad as it is in Europe and the UK. Wages growth in Australia is nowhere near what it is in places like the US, where it's running closer to 5 to 6. And so for that reason, we think we're a bit different. And so we might not have to raise rates as much, and we might be able to do it at a sort of less aggressive pace. What we see here is the government sort of, I guess, treading the middle ground there. So saying that wages will go up a bit from current levels, but not as much as we've seen in other jurisdictions. So I think, from my perspective, the jury is out on that one. And then just finally, the unemployment rate obviously has been revised higher. So Treasury is now saying that you can get to 4.5% on the unemployment rate, which is a whole percentage point higher than where we are at the moment. So that's a meaningful move. But even at 4.5%, even if those forecasts are right, that would still be a lower unemployment rate than prevailed pre-COVID. So most economists would sort of look at that and say 4.5 relative to the last couple of decades is still an amazing outcome. So I sort of look at those forecasts and go, they exactly represent the narrow path that the RBA is talking about. So this is the scenario where growth slows quite meaningfully, but we don't have a recession. Inflation is elevated, but ultimately comes back to target. And the only damage we inflict on the labour market is that the unemployment rate goes up a bit from 3.5 to 4.5 to settle at levels that is even lower than it was pre-COVID. So if that sounds like the Goldilocks outcome, that's because it is. And I think, the RBA is doing the right thing to acknowledge that the path to this outcome is a very narrow one. And my sense would be that I wouldn't be putting a probability of 50% or above on that outcome. I think it's probably more somewhere in the order of 10 to 30. So if we can engineer this, we'll be one of the few economies, I think, that will get out of the horrible inflation story with a soft landing and not a recession. But I think that's a pretty big if. So I'll finish up there and then hand over to Brian. Thank you.
Thank you, Sally. Very insightful. And the broader economic picture, I think, does set the scene. So I think despite some of the positives that were mentioned, I think the Treasurer would agree in many ways. He's been warning Australians that things will only get worse before they get better, pointing to deteriorating global conditions and high and rising inflation and interest rates. So he set the scene for what is now not time to do anything drastic. It's about caution and restraint. Good afternoon all. My name is Brian Farrelly. I'm a partner in the tax advisory group here at Pitcher Partners. It's my pleasure to be here this afternoon to provide an overview of some of the more specific measures on the tax announcements last night within the budget. It was a budget that should be setting us back on course after the last three budgets, which were given in the height of COVID and pre-election positioning. It's Labor's first budget night of over 10 years. One where they were really clearly keen to steady the ship while making some good on some of the pre-election promises. But there's plenty more that could have been done. What I'll be covering today will be an overview of the budget announcements in respect of taxation, impacting individuals, business, and some other tax measures as well. So as mentioned, there was a bit of doom and gloom in the budget rhetoric last night. And that there was need to be responsible. Jim Chambers spoke of the need to strengthen our buffers against adversity and lay the groundwork for the future, a stronger, more resilient Australia. So the budget focused on a few key areas: support for families, cleaner energy, housing affordability, and spending on education and improving aged care. But what was in there from a tax perspective? Well, I think as with recent federal budgets, there was very little in the way of surprises. There's always plenty of leaks leading up to budget night, and this year was no different. So the tax team again gathered around the table last night to watch the budget in anticipation. Something excitement might be happening. Perhaps this time we might see some true reforms, some structural changes. Maybe they'll clear that large pile of unacted measures that have been sitting there building up. So as soon as the speech starts, we all quickly dive into the documents, begin poring over them in earnest. I mean, the atmosphere is electric. This is our second tax accountant Super Bowl in 1 year. I mean, this is fantastic. Plus a new Labor government, anything could happen. Unfortunately, it doesn't take long for the sighs to be audible. Removing what we already knew about the budget, unfortunately, there wasn't too much else to sink our teeth into. So the key measures there were centered around government family-friendly packages, being the paid parental leave expansion and increased childcare subsidies. A few substantial measures around multinationals, which I'll talk to, aiming to increase their share of tax. Changes to share buyback rules that impact listed companies and their investors. And what's also been a regular theme in previous budgets, extra spending for the ATO to help generate tax revenue. But what was missing? Plenty. I think it underlines the stable and the responsible budget the Labor government were aiming for and targeting. Despite the significant media attention over the last month, the stage 3 tax cuts were not mentioned at all, actually, within the budget documents. Further, there's a number of tax cost of living relief measures which were not raised or extended. The lower middle income tax offset, for example, which has recently come to an end, temporary full expensing, which will run its course by 30 June 23, and the fuel excise discount that only ended 4 weeks ago. There was limited cost of living relief across the board. The government continues to reiterate they made announcements that deliver responsible cost of living relief, but I think for the majority of Australians outside of young families, there was no cost of relief provided at all. But then, in times of rising inflation, the responsible aspect of these measures may simply be the lack thereof. Finally, and importantly, there's been some material changes for multinationals, which we'll go through. But other than that, there was no structural long-term tax reform. So just looking at some of these matters and measures in a bit more detail. For individuals, the first is the extension of the paid parental leave. So the regime is a taxpayer-funded pay to new parents based on the national minimum wage. So paid parental leave currently allows the primary caregiver to take 18 weeks of work off work for the minimum wage, and the other parent gets an extra 2 weeks. So a combined 20 weeks, which the previous government proposed to merge. But under the proposed changes which were announced on last night, the total number of weeks available will actually gradually rise from 20 weeks up to 26 weeks. So that's a full 6 months off. A combined, and these, so from 20 to 26 with 2 weeks being added from 24, July 25 and July 26. Further, the enhanced policy is designed to increase flexibility, allowing parents to share the load of caring for the newborn children more equitably. From July of 23, you'll be able to take the leave in blocks as small as a single day at a time, allowing parents to go back to work in between. Meanwhile, single parents will be able to access the full entitlement. Another part of this measure is the government hoping to incentivise both caregivers to take time off work by dedicating a use it or lose it portion to the paid parental leave, which is still to be determined. Finally, the expansion of this policy is up by introducing a level of up to 350,000 as the threshold for family income, which is an increase of above the current 156K threshold. Childcare subsidies. So changes in these subsidies were previously announced pre-budget night, increases the maximum rate of the childcare subsidies from 85% up to 95% for the first child in care for families with income below 80,000. Now the sliding scale now spreads those child care subsidies right up until a combined family income of 530K rather than the current 356K mark. So the intention is to lift the subsidy that applies for all families up to 530K combined family income across the board. The testing's been done, and the talk on this one is that the childcare subsidy is expected to increase the hours worked by parents with young children by up to 1.4 million hours a week. So that's an additional 37,000 workers in the labour market. The measure applies from 1 July 2023. I wanted to put this slide and table up again, given all the recent media hype. It's worth touching base on the individual tax rates. This slide currently shows the current year individual tax rates, which are in the middle, as well as last year on the left and the next 2 years. The key point to highlight is that the low and middle income tax offset, referred to by many journalists as the Lamington, has dropped off from FY23. Now, this is effectively a 1,500 tax increase for 4.5 million Australians, and a tax increase for a further 5.6 million that receive part of this offset. Now, there may have been some hope that the government would extend this offset again, but alas, the Lamington is dead. Long live the Lamington. And then there are the stage 3 tax cuts, which appear to still have a lifeline for now. So that's on the right-hand side. There are at least 2 more opportunities for the government to pull these tax cuts, being the budgets next May and then again in May 24 before the changes come into effect from 1 July 24. So Labor have supported the Morrison government to legislate the stage 3 tax cuts. In 2019, it was part of the broader package with the stage 1 and stage 2 measures. Now, these 1 and 2 measures targeted low and middle income earners. They were rolled out, they were enhanced, they were accelerated at a total cost of about 170 billion. But every time they look at the stage 3 cuts going forward, the cost seems to blow out. Now, this is partially to do with how long you look out into the future as to what the costs would be. Over 6 years, the cost of the stage 3 cuts were initially estimated to be 141 billion. The Greens, they asked the Parliamentary Budget Office to look at this again last year, and they extended it out to 9 years and show why the cost is actually 243 billion. Again, this is bracket creep really at work. It's what is costing 17.7 billion in FY25 is actually costing twice that and more by 8 years later by FY33. The Labor government just looked at these numbers again and estimated the number was 254 billion, a further 11 billion on top of the existing estimates. So with the stage 3 disproportionately benefiting higher income earners, I suspect this case for scrapping these cuts may be mounting. Moving on to some measures for business. First one just to talk through is share buyback changes. So this measure effectively stops a tax-effective return of capital to shareholders under a strategy that has allowed super funds, charities, other low marginal rate taxpayers to maximise the cashing in of franking credits on buybacks from listed public companies. So going forward, the whole purchase price of these buybacks will be treated as a capital proceeds with no portion of it treated as a dividend, therefore limiting the amount of franking credits that are returned. So we understand there are about 30 listed companies that have completed about 50 such transactions over the last 6 years. But interestingly enough, this measure is expected to increase receipts by about 550 million over 4 years. So clearly there's been a few investors that have been benefiting to large extents. Key changes with respect to multinational tax integrity measures. So consistent with their pre-election promises, the government's proceeding with significant changes to the thin capitalisation rules for non-financial entities from 1 July 23. So the measures actually adopt the OECD recommendations and apply to entities that are members of multinational groups, both inbound and outbound. So the key aspects of these reforms is firstly to replace the current asset-based safe harbour tests, which deny interest deductions where a company's average debt exceeds 60% of the average value of the assets. Instead, a proposed earnings-based approach and test will apply to limit debt deductions for an income year to 30% of an entity's earnings before interest, taxes, depreciation and amortization. So 30% of EBITDA. Unlike other or current thin cap measures which operate to permanently deny those interest deductions, these rules the earnings-based rule will allow denied deductions to be carried forward and utilised for up to 15 years going forward. But it's important to note that these earnings-based tests will particularly affect our property developers and property funds that may incur debt deductions in the early years prior to generating income. In these projects, any change to the debt equity mix affects investor returns on equity performance fees by fund managers. But the government is silent on grandfathering or transitional relief, and we have very limited to go forth at the moment with respect to the detail of these rules. The other key changes within the thin cap change is with respect to the worldwide gearing tests with an earnings-based group ratio. The arm's length debt test will be retained, but it will only apply to an entity's external third-party debt, which disallows deductions for related party debt. So this will have a significant impact and restrict availability for a number of taxpayers with commercial capital structures that include related party debt. Existing thin cap rules with respect to financial entities will continue. So Pitcher Partners made a comprehensive submission on the proposed thin cap reforms in the recent Treasury consultation paper. We'll continue to closely monitor and scrutinise further consultation documents and exposure draft legislation and advocate for the middle market who will be unfairly impacted by these proposals in the multinational sense. There are a number of key technical issues, of course, with these changes, and the devil will be in the detail. Other multinational tax integrity measures, there's now a denial of deductions for payments that are related to intangibles, where the intangibles are located in low tax jurisdictions. And enhanced tax transparency rules have come through with respect to certain entities, which include significant global entities, which are greater than 1 billion global revenue turnover, Australian public companies listed and unlisted, as well as those that tender for Australian government contracts, which are greater than 200K in value. So as mentioned, the ATO are looking again to enhance their return on investment, spending an additional combined 1.8 billion in order to raise 5.6 billion, which is a north of a 300% return. So the increasing fundings come to extending their personal income tax compliance program. So that's targeted at individuals who are overclaiming or not complying, extending the shadow economy program, and extending the tax avoidance task force all the way to 30 June 26. That continues to focus on multinational enterprises, large public businesses, as well as private business and high wealth individuals. The announcements have become increasingly familiar at recent budgets and demonstrate that the ATO intend to be very busy over the next few years. So I mentioned the announced but unenacted measures. There are still approximately 70 previously announced measures that start dates way back to July 2015. There were over 80 of them. The government decided to deal with 12 of them last night by stating that 9 of them were being abandoned and 3 of them were being deferred. So these unenacted measures, I think, demonstrate Treasury's resources appear to be drained with big ticket changes impacting budget, as well as obviously the COVID measures over the last few years. Just a bit of history, there was a spring clean out of the, we call them the ABUMs, the announced but unenacted measures, back in November 2015 when the Abbott government came into play. They dealt with a backlog of 92 of these measures. At the time, they were whinging and whining about the Labor government letting it get so bad and building up, and yet here we are again. And before that, the clean out was back in 2008 when the Rudd government came to power. So it is a recurring theme. Unfortunately, however, there's been no mention of the key unenacted measures that we would like to see dealt with under this budget, and that still continue to sit there gathering dust. A couple of which are mentioned on the slide. So reforms to corporate tax residency definition. So an area of ongoing uncertainty. The ATO's transitional compliance approach on this expires 31 December this year. Superannuation, non-arm's length income and expense provisions, which were also required to provide some certainty in the space. There was no announcements with respect to Division 7A, which treats certain payments as dividends for private companies, payments and loans, that is. There's no changes or announcements with respect to the R&D incentive. Again, these were announced a couple of years ago and continue to be sitting there gathering dust. Another one that was of importance, which I'd like to have seen, was the patent box measures, which provide tax concessions for medical biotechnology innovations and agricultural sector and low emissions innovations. They're actually due to apply from 1 July this year, but again, have not been enacted. Just to round out some of the other measures from a tax perspective from the budget, there's obviously a keen push to take up on electric vehicles. Exemptions now being provided for FBT and import tariffs for cars with a ticket price below the electric vehicle luxury car tax threshold, which is just currently under 85K, and applies for cars acquired after 1 July 22. So this was announced a couple of months ago. One of the ABUMs we just mentioned that the government is abandoning is on depreciation on intangible depreciating assets. So the last May's budget, the government announced that you could self-assess the life of those intangible assets, and it was to be coming into effect from 1 July next year. The Labor government have made the decision to remove that, noting that it will save them $550 million over 4 years. Taxation of digital currency was also considered this time around, and it was confirmed that that will be taxed as an asset and not a foreign currency. So this comes off the back of a decision in El Salvador last year to adopt Bitcoin as legal tender. So the rules are saying, well, it's not actually foreign currency, it's still an asset that should be taxed on for CGT purposes to the extent it's a capital gain. The budget papers make it clear that government issued digital currencies and central bank digital currencies are foreign currencies. And finally, something to note, the penalty unit increases from 1 January next year by a whopping 24%, from $222 to $275. Now, obviously, it doesn't make much of a difference with respect to small penalties when we're talking 1 or 2 units, but for large groups, the potential impact is substantial. So in respect of significant global entities, the maximum failure to lodge penalty for any misstatement increases from 555,000 to 687,000 for a lodge statement, a late lodgement on an approved form. And this will increase by CPI from mid-2023. So these rates increases are expected to raise an additional 31 million over 4 years. So to wrap up on the tax front, the key takeaways from the budget for many Australian taxpayers, I think we can safely say it was fairly light on. It was designed as a stabilisation budget, hopefully setting the scene for some future changes, which we'll watch the space on. For individuals, the enhanced measures on paid parental leave and childcare subsidies will no doubt be welcome, but there was limited else on cost of living. For businesses, the most substantial changes actually related to the multinationals, but there was very little in there for small business with respect to either enhancing or interrupting their growth. On that note, I will finish up, but happy to take questions through the panel discussions as mentioned a little later on. And it's my pleasure to welcome Paul Guerrero to the stage.
Thank you, Brian. Budget's like budget night, Super Bowl for accountants. Might use that a bit later on back in the office as well. As Stuart did at the start, I'd like to acknowledge the traditional owners of the land on which we meet today, pay my respects to their elders past, present and emerging. Always great to be back at Pitcher Partners. You know, we enjoy a really treasured relationship with Pitcher Partners through the Melbourne Chamber of Commerce. And to you, Brendan, thank you for the opportunity to speak today. Fair to say it's been a big year in Australian politics. We had a federal budget in March, the election in May, another federal budget last night, and of course, we're not far away from the Victorian election in just a few weeks' time. I've had a text in, Brian, my policy leads back at the chamber say that's Super Bowl for them. So we'll see what that brings a bit later in November. So let's set the scene. Last night's budget was the fourth federal budget in 2 years. Comes at a crucial time as we emerge from the pandemic and deal with increasing economic uncertainty, not only here, but globally as well. And just as businesses were starting to enjoy coming out of COVID and the long-awaited economic recovery, we're now being buffeted by global forces, pretty much beyond our control. Turbulence of COVID has really morphed into rough economic headwinds that show no real signs of abating in the short term. Rising interest rates, high inflation, supply chain shocks, staff shortages, and an energy crisis have all arrived just as we were starting to get back into business. Pleasingly, from our view, last night's federal budget, the first delivered by the Albanese government, addressed a number of the challenges facing our economy and Australian business. The Victorian Chamber, on behalf of our 65,000 members and clients, put forward about 24 recommendations and priorities under the two themes of activating Victorian business and building our future. They prioritised targeted support for business, improving skills and training, investment in infrastructure and manufacturing, and easing the cost of doing business. Last night's budget did adopt some of our key recommendations, particularly around addressing the skills and labour shortages by maximising workforce participation, predominantly amongst females, pensioners and international students. These should have an immediate impact on the biggest issue facing businesses right now across our state. In particular, we welcomed expanding the permanent migration program by 195,000 in 22-23, with additional funding provided to accelerate visa processing, reducing the visa backlog, and raising awareness internationally for high-skilled migrants to assist in Australians' workforce and ultimately in Australia's permanent migration system. Relaxing work restrictions for students and secondary training visa holders to enable them to work additional hours in any sector until 30 June next year. Now, we note that still remained a cap, and we're satisfied with that as well, because predominantly the students are here to study, although they do make up an important part of our workforce, and it's good to see them being able to work a bit more. There were 480,000 fee-free TAFE and community case-based vocational education places over the next 4 years, which I know will please Sally Curtin, who's here as CEO of Bendigo Kangan Institute. And there's 20,000 more university places to underrepresented groups to study in areas of in-demand skills. And that's important because we'll start to build a workforce to address some of the skill shortages that we have. There's commitment to more than $100 million in the new energy apprenticeships and new energy skills area. Again, important because that's where we have to move to as a country. And encouraging higher workforce participation by delivering cheaper childcare and expanding paid parental leave to 26 weeks, as we just heard about from Brian before. There's also significant investment in industry development, including establishing a national reconstruction fund to provide $15 billion of capital to grow our industrial base, diversify our economy, and boost and support regional development and help build a future made in Australia. Modernising the electric grid to help put downward pressure on power prices and support the transformation to a clean energy future. We know that will take some time to kick in, but at least it's a step in the right direction. And additional investment in renewables generation and storage capacity to reduce our exposure to international energy prices and help meet our energy reduction commitments as well. And small business does get some support through delivering the better deal for small business, which will include investing in energy efficiency, workplace relations support, and wellbeing programs. And of course, as we heard about from Brian, retaining the 20% tax deduction boost for small businesses to upskill employees and embrace new technology as well. Infrastructure was a focus of the budget, with a number of initiatives, including delivering a $10 billion investment into the Housing Australia Future Fund, which will provide 50,000 affordable and social homes via this fund and the National Housing Accord. $2.2 billion for us here in Victoria for the Suburban Rail Loop, $156 million for the Geelong City Deal projects. I'm smiling because I think Geelong always manages to come out well under a federal government. $156 $500 million to reduce transport emissions, including electric vehicle charging stations and government fleet purchases of 75% electric vehicles. Rewiring the nation with $20 billion in low-cost finance to make upgrades to the electricity grid, including what will be an important Marinus link between Tasmania and Victoria, and $2.4 billion expansion of the NBN over the next 4 years to boost digital capability, particularly in regional Victoria. Again, that's important for us in regional Victoria there. And finally, $161 million over 4 years for trade and tourism, including $48 million for recruitment and marketing, $36.8 million over 4 years supporting the arts sector, and about $140 million over the next 3 years for the aviation sector. All of these initiatives from our perspective are important because the private sector will be critical as our economy rebounds, and it's more important than ever that government continues to prioritise funding that will help improve business conditions as Australia, as I mentioned early on, hit more of those economic constraints, both what's generated here, but particularly abroad. So I guess the question is, will it be enough? Context, fourth budget in 2 years. It's really another interim budget. The new government, in our view, is resetting the agenda on its terms, not the previous government's. When I spoke to my team last night, we internally dubbed it the placeholder budget. And as my uncle would have termed, yep, it's not bad. There are enough positives around the skills and job shortages, and these required addressing. The internationals will come back, but they have choices now. So we need to be on the front foot. And the people we skill up will have choices too. So we need to find reasons for them to stay in Victoria. But we need also to ensure that business remains at the forefront. When business does well, the state does well. There are some watch outs from our perspective. There is a question around the allocation of money for manufacturing in the National Reconstruction Fund, and how does Victoria best benefit from it? And then to highlight that, hidden in the papers, there's a Revitalising Australian Industries Fund to provide grants of $113 million for manufacturing upgrades, which will boost our competitiveness, invest in our regions, and reduce our carbon output. A couple of highlights there. $50 million to upgrade the Hobart zinc smelter in Tasmania. $17 million to establish a pilot food manufacturing innovation hub in New South Wales. $12 million to support Springfield Biopark project in Queensland. $11.1 million to support upgrades to Ingham Sorrells poultry facility in Tasmania. $10 million to support Flinders University's Factory of the Future in South Australia. $6.1 million to upgrade the Waverley Wool Mill in Launceston in Tasmania. There wasn't any in that fund for Victoria. Aren't we meant to be the manufacturing state? Aren't we meant to be the largest manufacturing state in Australia? And when I look at the food innovation side, which I know we've been trying to get up in conjunction with La Trobe University and CSIRO, aren't we meant to be the food bowl of Asia Pacific? So there's a couple of watch outs there. Further, we'd hope for support for the intermodal freight terminal in Western Melbourne. Now that's not dead. We know they're actually looking at that in a different way with the Inland Rail Review. So we hope something will come out of that. We're hoping for the expansion of the Export Market Development Grant, because we believe one of the ways Victorian businesses can improve is to increase the marketplace in which they sell to, and assisting Victorian business to export, which we think somewhere between 3 to 5%. Yes, 3 to 5% of Victorian businesses export. We think there's a massive opportunity to pick that up. And then we thought there was some more opportunity in the tourism side, particularly around resilience and rebuilding some of the infrastructure in Victorian tourisms. So we've got to be a bit more nimble to be able to utilise that money that's in there for tourism than what we might have been otherwise. We do need to see some real outcomes from the NDM funding to address the black spots that exist in regional Victoria, and we've heard about them a lot through COVID. The focus on tourism is good. Done properly, it will see some more tourists return. As I said earlier, we've got to make sure we're nimble enough to pick those tourists so they come into Victoria. The commentary around platforms for bargaining for small business is another area to watch. And there's an advocacy group called COSBOA, which has probably led us down a particularly difficult path in that. Between the Australian Chamber, the AI group and the BCA, we'll be doing our best to make sure that business is put first there, and that small and medium businesses aren't impacted by some of the conditions that may be set out in that. And I think small to medium businesses will be keeping a watch on rising energy costs, as there wasn't much in the short term to assist there. I've spoken to both our State Treasurer and the Minister for Industry and Transport today, Minister Carroll. In fact, Scott Benkawaria Scott hosted a lunch with Ben Carroll at lunch today with some key Melbourne Chamber members. It was interesting. They were pretty comfortable with where the budget landed, mainly because they felt the Federal Treasurer had taken their input and had reflected it accordingly back in the budget. Without question, though, and I spoke to the Treasurer about this, once the outcome of the state election is known, there needs to be eyes fixed on what we need to come out of the budget in May next year to make sure that Victoria continues to recover post-COVID and plants the seeds for what the future was going to be. So in all, I guess we got an amount that we advocated for. It does feel like a reasonable balance for an interim budget and sets the agenda for what's ahead for the current federal government. Earlier, Stuart referred to the forthcoming state election, November 26. Next week, the government, in fact, 6 o'clock on Cup Day, the state government will officially go into caretaker mode, marking the real start of what will be the election campaign. And like the federal budget, the Victorian election is also a great opportunity for business to use its voice. We at the Victorian Chamber spent a lot of time working with businesses all around the states, and we've come up with what we've termed our election platform, Powering Victoria's Future. If you hadn't had a chance to have a look at that, please jump onto our website. You'll find it there. As you've probably seen over the journey of COVID, Vecchi has chosen to focus on solutions, and will continue to do that, not only in the lead up to this federal budget, but in the lead up to the state election as well. We want to make sure that we're representing the voices all across the state, and those voices that make a difference will be the voices of business. And I think we've earned that respect over time, and I think that's why we've been able to see a number of our recommendations get some funding in the budget last night. No question, there's economic headwinds coming up, but I, like many people in the room, remain optimistic about the future of our state and, importantly, the future of Victoria as well. Predominantly because we'll keep putting business interests first, because that will drive us out of this. Thanks.
Thanks very much, Paul, and our other speakers, Sally and Brian today. Fantastic insights. Could I just invite Sally and Brian up onto the stage? Yeah, thanks very much, guys. Really, really great presentations from each of you. As I said, there are some questions coming through. Might kick off with a question for you, Sally. You spoke about the commodity price assumptions in the budget. And that is something that's always fascinated me, that the commodity prices assumptions always seem to be quite low, particularly that iron ore price. It's, as you said, I think it's $55 a tonne that it's been baked in for goodness knows how long in the prior budgets. When the budgets are actually being delivered, the price has been way above that. And I think what you were saying is that reflects some prudence in the Treasury forecasts. Is that sensible prudence, do you think, or is it really just a cushioning of some of the other things that perhaps don't pan out as a government would like in the budget results?
So I think it's probably a bit of both. I mean, governments like that trick because, as you said, invariably the price spends far more time above 55 than it does below. And so it provides them with a natural windfall gain, which means they can always deliver a better outcome than they thought. What was interesting last night was the Treasurer made the point that in his first budget, of that windfall gain that was delivered to them through commodity prices and a better labour market, they were actually banking 90% of that. Whereas they were saying in previous budgets, going back 7 or 8 years, the sort of trend had been for previous treasurers to actually spend 60% of the windfall and bank 40. So I mean, there's different ways of sort of dealing with, forecasts for commodity prices. You can just put in the 55, which is maybe probably quite conservative, or you could take what the futures market has priced in and use that as a sort of expected path for commodity prices. But I think because commodities are just fundamentally so volatile, it's just probably, easier. And I think it's sort of well understood the way Treasury go about it. So it's sort of like any forecast for anything. I mean, there are different ways you can approach it and different numbers you can put in, but it seems to be one that Treasury is comfortable with. And I think treasurers like it because invariably it delivers them a nice windfall gain.
Okay. Got another question that's come through here, this time for you, Brian. The question is, what does the increased funding for the ATO compliance mean for business into the future?
Yeah, thank you, Stuart. Well, I think it goes without saying it demonstrates the ATO will continue to spend the time and the effort chasing down what they see as adverse outcomes from a tax perspective and trying to get a return for their dollar. So when their tax avoidance task force, they spent, I think 2 years ago, they added another additional 1 billion to the top up, and then in May they'd said another 680, and I think this time around it's another circa 1.2. So there's a little bit of cash floating around there for the ATO to recruit, to go out and spend the time and effort, and with respect to their assurance reviews and risk reviews, and we're seeing that across the board, across our client base. The amount of the time and the effort that it's taking to go through these assurance reviews, and the amount of effort that is required on both sides to work through it is substantial. So I think it's here to stay by the sounds of it with respect to that level of inquiry, and it's about businesses being aware to it and having the house in order.
Yeah, absolutely agree. We are really seeing it in practice, and the funding numbers that came out last night, you sort of think, well, it's only going to continue and potentially ramp up quite a bit more as well. Paul, a question for you here has come in. What does the projected population growth in Victoria mean for bringing people back to the CBD?
The age-old question. I think people coming back to the CBD is a function of international students coming back in. And we hope to see an increase in that, but also a function of people coming back into the office, which, is a leadership responsibility for, the leaders that have businesses in the CBD. I think the ways we've worked have changed. I don't think we're going back to 5 days a week in the office anytime soon, but, an uplift to 3 days a week would see a meaningful increase in the amount of people in the CBD Monday to Friday. It's interesting that, after 5, Monday to Thursday and weekends, the CBD numbers are going gangbusters. 90,000 people at the cricket on Sunday is a great example of what events and the like, and the theatres and the restaurants are bringing back in. Friday, interestingly, softened a bit after 5 here a little bit. We think that'll come back in the summer months. So it's not after 5 and it's not weekends that's the issue. It's the Monday to Friday, 9 to 5. And as I said, if we can get leaders making a commitment to bring their staff back in, for even 3 days a week, that will be a meaningful difference. There's no question, though, that as international students start to come back in, we'll see more people naturally come back into the CBD too.
I might come back to you with some other questions, Paul, around some of the funding and grants programs that you mentioned in your speech as well. In the meantime, another question that's come through, does the panel have a view on the government encouraging big super to invest in community and affordable housing? Sure, who wants to have a go at tackling that? Sally, have you got views on that?
I mean, I have to say, when I saw that yesterday afternoon, it did remind me of what one of the New Zealand governments tried to do in recent times, which was a similar sort of ambition to build, I think it was 1 million homes or something crazy. And I think up to now they haven't even done 2,000. So, I think one of the issues is, you can see from an economic perspective that the market for housing feels like it's in undersupply because rents are going up quite rapidly in all capital cities. So already you're starting that program from a position where, you feel like more houses need to be built. And then the inevitable question is, where are the resources to do that going to come from in a sector that already feels like it's pretty capacity constrained? And sure, we'll have, a period of weaker economic growth and that might release some capacity, but housing and particularly construction tends to be one of the highly cyclical sectors of the economy. And so as we come through the other side, that'll be one of the first ones to rebound. So I think the the whole idea of doing something around affordable housing is super important, because I think we all acknowledge there is, a housing problem or a housing crisis, however you want to describe it. It's just the method through which you do that and the practicalities of it. But I think there was some deliberateness in calling it a housing accord. I think they wanted to sort of, go back to what we saw, in the early 80s with the Hawke government and the ACTU. So I think there was trying to have a sense of, you've got the right people in the room and together you can knock heads together and come up with a solution that works. So I think it's the right ambition, but I think the execution of it is going to be reasonably tricky.
And that was very clear that came through as well, wasn't it? That it was an aspirational target through the Accord, with some initial funding to kick it off, I guess, was the aim. Paul, you were going to add to that?
Yeah, so around, particularly regional Victoria, there's issues around getting staff. And part of the reason that they can't get staff is there's nowhere for people to stay. So there's no question of the availability of housing. We need Sally and her cohort to produce more plumbers, carpenters, and the like to build these houses quicker. But you've also got the issue around supply of materials, which isn't getting any easier anytime soon. The question will be, from a superannuation side, of which we all have superannuation funding, what's the return we expect our super to grow at each year? And if super companies start investing in areas that aren't going to give us the return that we want, I suspect there'll be a bigger backlash on that. So I think there's some work to do in it. It's interesting that we've had that announcement off the back of the Andrews government announcement in terms of what they're doing by bringing the SEC back, which is also including superannuations companies into it. So I think there's a bit to play out. The ambition, as Sally said, I think is right, but I think we all want to see what the returns can be.
And my understanding is that that was part of the announcement last night around the initial 350 mil that's being tipped in. It was fairly light on detail, but it seemed to suggest that was going to that funding would be used to bridge that gap between subsidised rent and market rent. I guess the question is it still a juicy enough return, and is it big enough really to kick things off and get it going to the aspirational levels that they're hoping for through the Accord?
Good thing is if superannuations companies continue to look for opportunities in Australia, we are going to be better off, but we still want the return.
Another question that's come through, the number one issue common to all employers appears not to have been mentioned, an employee shortage. Is there any support in this budget to address that?
I mean, in the short term, I guess it's all about the migration story. So, population growth is going to accelerate pretty quickly. It's going to get back to 1.4%, which would even be maybe about where it was pre-pandemic. So I guess that's one way through which we can, increase the supply of workers. The problem we have in Australia is that when you look at what people call the participation rate, so that's effectively when we look at the labour force, so pretty much anyone between 16 and 65, what proportion of the labour force are either employed or actively looking for a job, that's sitting at pretty much close to record highs. And so what that tells you is that it's not like there is a pool of, disengaged workers who once used to have jobs but can't be bothered anymore. We've basically sucked anyone who wants a job into the labour force. And so there's, in the short run, very few levers you can pull to do anything about that. So that's not a problem you can easily solve overnight, but running net migration at relatively elevated levels, and then the considerable investment in skills and education, as Paul spoke to, I think will help the problem, but I don't think it helps in the very near term.
Yeah, just to build on that, there's probably two other parts that were addressed in the budget. The first is the childcare subsidy, which we will think have a meaningful impact on the ability of predominantly females, women, to come back into the workforce. So that's absolutely a good thing. There's a rise in the pensioner level of what they're able to earn, and we're hoping that will encourage a few more of the retirees to come back into the workforce without impacting their pension. And there was a small, and it's obtrusive to most of us, but international students coming back in, they do make up a percentage of the workforce, and to see a lift in the amount of hours that they're able to work as they come back in and able to work those, we think that's important. But we also think it was right to put a cap on that as well, because they're here to study predominantly. if they then can do some work, that absolutely helps our workforce too. So yes, there was a bit in there in terms of available workforce, but as Sally said, finding people that aren't in the workforce at the moment, that's the difficulty. So encouraging more internationals to come back in quicker is the key. Finding those that can't get into the workforce, whether it be childcare or others, that's being solved for.
Yeah, I mean, I think the one on the pension to me is an obvious no-brainer, because you should just not have any restrictions on it, because either way, the government wins, right? I mean, so to say to the person who comes back in, keep your pension, you have to pay a bit of tax on the income you earn, the economy's better off, the government's better off, the worker's better off, and no one loses in that situation.
We went a step further and suggested there could be a second job incentive as well. So, perhaps if the tax-free threshold, let's call it 19,000 on your first job, if your second job, you have a tax-free threshold of 9,500, it might encourage people that as costs are going up, and let's not forget this, as costs are going up for people that want to work a bit more in a second job and get some more income to offset those costs, maybe there's some encouragement there, which ultimately then helps business as well.
Yeah, interesting. Question for you, Brian, that's come through. What business stimulus measures are? Specifically, can we still use temporary full expensing? I think you spoke about some of these measures that have got a bit of time to burn, but perhaps if you could take us through that.
Yeah, thanks, Stuart. Look, there was very little in the budget announcements from last night on business and stimulus measures. I think the measures that were announced in previous budgets, they'll still continue to be there. So we've got the temporary full expensing, which is due to run its course till 30 June next year. So that applies for businesses less than 5 billion in turnover, can take an instant deduction on their depreciable assets. But it drops off from next June. So back down to $1,000 cap for small businesses. So it's still there to run, but at nothing beyond. Loss carryback is still there till for FY23 for companies to carry back their losses from profitable years from FY19. So that still sits in place. Beyond that, very little at the moment. Yeah.
I guess sticking with tax, maybe a question for all the panel as well, because I think everyone can have a view on this, and we could probably run a book and take bets with Spring Racing Carnival just around the corner. What's the view on whether the stage 3 tax cuts will be implemented? What's the view of each of you on the panel?
I'm happy to start off from the tax perspective, which I think in my view is anything can happen. The rhetoric is there, I think, to give Labor the opportunity to remove it, unfortunately, in my mind. I think the talk of the costs and the talk of who it's benefiting versus others, it doesn't sound like a Labor policy. So I wouldn't be surprised if it was to be taken off. I think there's arguments either way, but it was introduced as part of a broader measure with other staged tax cuts and changes. And I think everyone agreed at the time it was the best approach. But where I'm heading, I think it's every chance that it will be removed.
$1. I've got no doubt they'll come off. It'll be a question of when that occurs. We hear about where inflation's going to get to. We hear about what the interest is going to cost us as a country on a yearly basis. It's an easy one to knock off as the economy tightens up. So it'll be a question of whether they do it next year or whether they do it the year after.
I mean, I think it's a shame that that's what the tax debate is at the moment, whether they'll go ahead or whether they won't, because really the argument is we need to have a much broader discussion about the tax system as a whole. But I think Chalmers has set up the conversation such that, by the time May next year or even May 24 rolls around, the conversation is all about we're running a structural budget deficit. How can we fix that? Now is not, we're not going to fix that by giving income tax cuts unless we're going to be doing quite drastic things elsewhere in tax policy, and sort of feel like the longer that conversation goes and the further that that decision is sort of pushed out, the closer you get to the next election, and the chances of doing really meaningful reform to the tax system, I think, probably decrease. So
a budget repair levy, perhaps, Sally? That was something going back to 2019, I mean, Labor had a lot of
I mean, that's meant to
wacky
be,
policies at
yeah, I
that
mean, that's
time,
meant to
but
be a sort of cyclical fix. I mean, we've got a structural fix. So, you know, a budget repair levy that goes for 10 plus years is just a tax rise. So I'm not sure that one's going to fly. But yeah, I think I guess, you know, for those who are able to lobby for a broader conversation around tax, it makes a lot more sense to me, not just to be looking at that in isolation, but as part of a whole tax system.
couldn't agree with you more. A levy is definitely not a structural reform or structural solution. Another question for you, Sally. You mentioned the chance of the government, RBA executing a soft landing were low. What's your house view for GDP, unemployment and interest rates?
So we don't really do, in my old job, I would have had numbers for all of those, but we don't sort of forecast, you know, to that level of precision. But, you know, my sense is, you know, we're going to have a world where, you know, Europe and the US are basically in recession now. Sorry, Europe and the UK are in recession now. The US, I think, will probably be there in some time in the first half of 2023. And as I said, you know, China is probably likely to grow at 3 point something this year, much lower than where it would normally sort of sit. So the global backdrop, I think, is, you know, for all the sort of talk that Chalmers gave us on storm clouds are gathering and all that sort of stuff, it's actually a fair assessment. And I think, you know, he went to the World Bank and IMF meetings in Washington earlier this month. And from what I understand, you know, that the mood at those meetings was very, very somber. And so it's not surprising that he sort of come back, I think, a little bit frightened about what lies ahead globally, at least. And so for us, you know, we've had this phenomenal run where the last couple of global recessions in 2001 and 2008, we've basically ducked. And so the question is, can we do it again? And like I said, I think the chances of us doing that are reasonably slim. So, you know, my sense is we'll get GDP next year, probably somewhere between 1 and 1.5. So I suspect a little bit lower than Treasury forecasts. I think the unemployment rate probably won't peak out at 4.5. It might get a bit closer to 5, because what you tend to find, and there's huge amounts of empirical evidence for this in the US, is that the unemployment rate is one of those variables that when it starts moving higher, it tends to keep on going. So it's not one of those variables where you think you can give it a bit of a nudge and it moves a little bit and then just sort of stops. It tends to sort of go quite exponentially. So when these things move, they don't tend to stop after a little while. And inflation will eventually come down. And, you know, I think we're already starting to see the early signs of that in the US. So there's enough visibility around what a lot of commodity prices have done, what goods prices are doing, to be comfortable that, you know, we are peaking out in inflation in most jurisdictions, Europe aside, and Australia aside, but inflation will come lower. The question really for policymakers is, how quickly does it come lower? And I think the risks are that you have a sort of slower descent in inflation than perhaps people expect. But we have to remember that central banks are set up with an explicit legislated mandate to target inflation. That's what they're there to do. So if they're not doing that, then they basically have no reason to be. And, you know, this is why you hear central bankers repeatedly say, we will do whatever is necessary to bring inflation down. And in the US, they've been super clear about saying, if we're going to make a mistake as we go through this process, the one mistake we're willing to make is basically pushing rates too high, keeping them there for too long, and forcing a recession. The mistake that we will not make is thinking we've done a great job, cutting rates back to lower levels, and then waking up one morning and finding out that actually inflation isn't where we thought it was, and we've got to start the process all over again. And so they've been really clear about saying that is one thing we are definitely not willing to do. And so often central banking just comes down to a choice of which mistake would you prefer to make. And they're basically saying, if we're going to make one, it's probably going to be a recession. So I sort of feel like that sort of forecast that Treasury gave us last night, they're really nice, but, you know, I think the risks are pretty one-sided.
A disciplined approach. So I think what I've taken out of that is that it's important to remember that the budget forecasts are all predicated on a complex set of assumptions. Invariably, these will be will be driven by fundamentals such as growth, inflation, core commodity prices, general trading conditions. And as we've seen, things can change so quickly in the world today. So who knows where we'll be when the main budget, not the mini budget, the main budget in May next year comes out. Has the government written most of what they expect to have in that budget already and are just waiting for the right time to drop it, or are they going to have to start again in terms of what they're preparing at that stage? Regardless, in the meantime, for our business, staying flexible, efficient, productive will be as important as ever, and just getting on with things in the Australian middle market for the year ahead. It's been great to see so many people here today. Before we draw today's door prizes, just hang on a sec, Bella, I'd like to thank my partners and colleagues for everything that goes into putting this event together, and all the collateral analysis that you'll see, that you will have received emails on, that you'll see on our website, et cetera. That's from our Gun Tax Advisory team, awesome team, poring over the budget papers last night, to our fantastic client experience and marketing team, to ensuring that our communications get to you in the speediest fashion possible and are as insightful as possible as well. Today's session has been recorded, so we will share the recording for you if you'd like to share it with colleagues, friends or family, maybe, or just to watch a replay again yourselves. So before we wrap up, I'll ask Sally and Paul to help select our door prizes that we have today. We have one for the in-person attendees, I believe. And this is the one for the online. Mr. Ian Thorpe. Ian, congratulations. You'll be taking home a Hamper Emporium vodka spiced orange hamper. Our second prize is a Hamper Emporium Foods hamper, and we've drawn that online here, and the winner of that is Winnie Ho. So congratulations, Winnie, on its way to you. Thanks again very much for joining us today. Hope you can stay for some canapes and drinks and nibbles and networking and getting together. See you in May. Thanks very much.